Listen carefully, because what gold and silver just did is the kind of move that forces people to rewrite their beliefs in real time. For months, the script was the same. That was the peak. Fake breakout. Blow off top. Get out while you can. And then the market did what it always does best. It made the confident look clueless. Gold didn't roll over. It pushed. Silver didn't fade quietly. It lunged. We didn't just retest old highs. We punched through them with enough force that even the loudest skeptics had to lower their volume. And here's what most people still haven't processed. This wasn't a random spike. This was continuation. This was confirmation. This was the market saying, no, I'm not done yet. Before we go deeper, quick request. If you're tired of copy-paste metal content and you actually want original thinking, hit subscribe right now and drop, or ELOG, in the comments so I know you're part of the core community. Now, back to what matters. Silver just printed the kind of weekly move that barely shows up on a long-term chart. Even after a late week shakeout, the candle still screams one thing: volatility is awake. Silver isn't a sleepy commodity, it's a compressed spring, and when it releases, it forces you to rethink your time horizon. Gold, meanwhile, is doing what gold does when the world quietly rots under the surface. It climbs while people argue. It climbs while stocks pretend nothing is wrong. It climbs while central banks smile into cameras and tell you they're data dependent. It climbs while the average person is still scrolling, not hedging. Yes, the S&P is up. Yes, the everything bubble looks alive. But when you overlay the scoreboard of real assets, hard, scarce, not counterparty risk assets, that shiny equity story suddenly looks less heroic. In this video, I'm going to walk you through 7 key ideas: why this doesn't look like a real top, why the 2011 playbook is being misread, how foreign currency benchmarking changes your price targets, why momentum matters more than people admit, why access and rules may become a bigger problem than price, how to protect yourself from emotional decisions in a fast market, and what I'm personally watching next: not hype, but signals. Stay with me until the end, because the last part isn't about price at all. It's about permission. And once that changes, the game board tilts for everyone. Let's start by killing the "this is the top" story. A real top doesn't just tag the high, wobble a bit, and then explode higher. A real top has a very recognizable personality. After a true peak, price fails fast. Rallies are weak and short-lived. Bid depth disappears. Volatility turns from healthy swings into oogly air pockets. And most importantly, the market fails again and again to reclaim the old high with authority. That is not what we just saw. We watched price revisit the old high. We watched the double top crowd celebrate. We watched screenshots fly around with clean horizontal lines and overconfident captions. And then price stepped over that line and kept walking. That is not exhaustion. That is breakout behavior. Weekly closes confirm this. Intraday spikes can be noise. Algorithms can fake a level for an hour. Daily candles can still mislead you, but weekly closes, that's where the bigger money leaves footprints. That's where conviction shows up. This week, both gold and silver printed the kind of weekly candles you mark on your calendar. You don't get that from a bunch of retail traders clicking phones. You get that when liquidity is thin, demand is persistent, and there are real players who need exposure, not just entertainment. Now, I know what's in the back of your mind. Okay, but what if this is just the final blow-off before a brutal crash? Fair. Here's the simple test I used: time spent near the high. Past cycle peaks in metals did not politely hover at the top for weeks. They spiked, stalled briefly, and then gravity took control. You saw waterfall declines, brutal drawdowns, and a parade of regret. This time, instead of getting rejected and collapsing, we've seen something very different. We tested the highs. We digested, we built a range, and then we advanced again. That pattern matters. It tells you there are still real buyers under the surface. Buyers who are not just trying to flip a one-a-day candle. Buyers who are accumulating because they need inventory, they need protection, or they need insurance against policy error. And remember this subtle truth: gold and silver do not need to be popular to rise. They only need to be scarce relative to the capital trying to get in. Popularity comes later. Scarcity drives the early phase. Momentum is how that scarcity expresses itself on the chart. Momentum is not a buzzword. It's the market's way of telling you. The path of least resistance has changed. When every rally gets sold, you're in a distribution regime. When every dip gets bought, you're in an accumulation regime. Right now, dips are getting absorbed fast. If you're waiting for the perfect, deep pullback that matches the picture in your head, understand something: in powerful uptrends, that textbook entry often never arrives. You get shallow shakeouts, higher lows, and sudden launches that leave the cautious behind. That's how bull markets punish hesitation. Now let's talk about the ghost that gets dragged out every time metals run 2011. People remember the feeling? The vertical charts. The panic, the sense that this can't keep going, and then the painful crash that followed. So they think it went parabolic then and died. It must do the same now. That's not analysis. That's trauma. 2011 wasn't just gold went up, then went down. 2011 was a pressure cooker, fresh scars from the global financial crisis, Eurozone debt fear, emergency policy improvisation, sovereign bond markets flashing sirens. and a belief still alive at that time that coordinated global policy could paper over anything. That emotional cocktail matters because blow-off tops are not just about price. They're about positioning plus psychology plus policy. Ask yourself, are we in that same panic peak window right now? In my view, not yet. Not because the world is safe. Because the synchronized fear that creates a true blow-off feels more like something ahead of us than behind us. In some ways, today's backdrop is more dangerous. Debt is bigger. Deficits are structural, not temporary. Geopolitics are more fractured, not more cooperative. Trade is a weapon. Supply chains are strategic. Resource access is leverage. In 2011, there was still a widespread belief that the grown-ups would coordinate and stabilize. Today, there is a creeping sense that the referees are part of the game. Gold and silver are not just commodities. They are confidence thermometers. They measure trust in policy, trust in money, trust in institutions. When that trust decays, metals don't need a marketing campaign. They respond automatically. Now look at interest rates, because this is the part almost everyone glosses over. Major secular tops in precious metals usually do not happen, while central banks are still openly talking about cuts or easing. The big macro tailwind is built during the easy money and financial repression phase. When the rate cycle has decisively bottomed and real rates rise and stay positive, that's usually when metals stop being the main show. Right now, we're in a world where rate cuts are being priced. Liquidity tools are still being used, and no one believes we're going back to hard money discipline anytime soon. Could we see violent pullbacks? Of course. Especially in silver. Silver crashes hard even inside strong bull markets. That's the psychological entrance fee. But a savage correction and a cycle-ending top are not the same thing. Zoom out. This doesn't look like an ending. It looks like the acceleration phase of a larger move. We are somewhere between this is a niche trade and the public is reluctantly paying attention. The wildest phase usually comes after I guess this is real. And before everyone at the barbershop is talking about it, we are not at the barbershop phase yet. Now let's stretch your lens beyond the US dollar, because this is where most people's analysis falls apart. If you only ever look at gold and silver priced in dollars, you are staring through a keyhole, not looking through a window. The dollar is important, yes, but is one currency in a system full of leaking boats. Many countries have already lived through what Americans still call a hypothetical. They've watched their currencies erode in purchasing power. They've watched savings get silently taxed by inflation. They've watched their gold charts go from interesting to shocking. Price gold in those currencies, yen, euros, pounds, rupees, pesos, you name it, and you notice something, the new all-time high story is old news in a lot of places. In several currencies, gold hasn't just broken the previous peak, it has left it far behind. For them, that 2011 high is a distant memory, not a ceiling. Now bring your eyes back to the dollar chart and the picture changes. You stop thinking, wow, gold is stretched. You start thinking, the dollar is behind the curve. That's what benchmarking does. You compare old peak versus current price in multiple currencies. You see where the metal has already repriced for currency decay, and you can build a rough window for what a similar repricing could look like in dollars if US policy keeps drifting in the same direction. Do the same exercise with silver, and it becomes even more dramatic. Silver is smaller, jumpier, more sensitive to flows. In several currencies, the old silver peaks have already been smashed. In dollars, silver has ripped, yes, but relative to the global template, it still has open runway. That doesn't mean we go straight up in a line. It means people are underestimating what is mathematically possible if debt keeps growing, deficits stay structural. Policy keeps favoring stability now, currency later, and industrial demand collides with investor demand. In that world, 4-digit gold and triple-digit silver are not fantasies. They are scenarios you should at least be mentally prepared for, not guarantees, not next week calls, scenarios. Here's the psychological trap. By the time those numbers are on the screen, the story will be loud, emotional, and crowded. The temptation to chase will be extreme. That's why you build your plan before those levels, not during. And one more thing. If you live in a country where gold has already printed huge gains in your local currency, drop a comment and share your experience. People in stronger currency regions need to see what this looks like from your side of the fence. Let's deal with a question that fills my inbox every time silver explodes. Are the big players trapped? Are the banks short? Will someone get blown up? Here's my answer. Sometimes, yes, there are concentrated positions that lean hard against silver. Sometimes there are attempts to manage volatility. Sometimes there are coincidental market glitches right when things get wild. But obsessing over one villain misses the bigger point. In the modern system, large institutions get rescued. We've seen it over and over: new facilities, new backstops, new acronyms no one can explain, accounting rule changes that magically smooth the pain. When they do that, what gets created? More promises, more guarantees, more currency units. That is long-term fuel for metals. Instead of fixating on one narrative about one bank or one short, watch behavior on the tape. When you see repeated dump attempts that fail to break the structure, when you see sharp intraday hits that get bought back quickly, when you see bad news, knock price down for an hour and then disappear from the chart. That often means strong hands are absorbing supply. Some smashdowns aren't attempts to kill the move. They are attempts to enter the move cheaper. Now zoom out to the real constraint: physical metal. Paper claims can multiply. Derivatives can be layered. Synthetic exposure can be spun up in minutes, but real ounces don't print themselves. Industrial users don't care about your favorite YouTube channel. They care about delivery dates, inventory levels, production schedules. If the pipeline of real metal tightens while investor interest rises, price becomes the rationing tool. That's why silver, especially, can flip from ignored to impossible at shocking speed. If we move into a phase where procurement managers, manufacturers, and utilities start competing with investors for the same finite pool of metal, the tone of the news flow will change overnight. You'll start hearing delayed shipments, allocation limits, longer lead times, and premiums that have nothing to do with spot. If that happens, the people who quietly built positions when it was boring will be playing a completely different game than the people trying to rush in at the last second. So if you see value in owning real metal, the time to build is when forms are simple, questions are mild, and dealers still pick up the phone on the first ring. Now we have to talk about something most channels avoid: access. In the early phase of a bull market, your biggest battle is internal. You're fighting doubt, mockery, and your own hesitation. In the later phase, the battle may not be, can I afford it? It might be, will the system let me move how I want when I want? Systems protect themselves. We've seen it in banking crises. We've seen it in emergency regulations. We've seen it in temporary programs that never really go away. When stress rises, rules tend to become flexible for institutions, rigid for individuals. What does that look like in practice? You try to wire a meaningful amount to a bullion dealer and suddenly, the bank wants extra documentation. They want you to come in person. They flag the transaction for your safety. They delay the funds for Orview. And yes, there are real scams out there. Yes, compliance matters, but blanket friction doesn't feel like protection. It feels like control. If enough people start trying to move serious money out of digital claims and into hard assets, the incentives are clear. Slow the outflow, push more questions, add more steps. Most of the time, the system doesn't need to say, you can't. It's enough to say, you can, but it will be a headache, expensive, and time-consuming. That alone filters out a huge percentage of people. If that isn't enough, there's another tool: taxes and reporting. You can keep something technically legal while making it financially unattractive. Extra taxes on certain purchases, special reporting thresholds, different treatment on gains. In some places, these structures already exist. The result: physical metal trades at a structural premium over spot, not just because of dealer margins, but because of legal and tax friction. That creates a strange dynamic. The person who quietly accumulated before the rules tightened has an edge the latecomer can never copy. Layer on another issue: affordability. When silver is cheap in nominal terms, an average household can stack meaningful ounces over time, almost without noticing. As price climbs, the number of ounces most people can buy each month shrinks. In late stages of a bull, people are often buying grams and fractions where early movers were buying kilos. You don't do that to win against anyone else. You do it to win against your future self, who will wish you acted while the path was clearer and cheaper. If you believe you want exposure, relying on a last-minute, emotional scramble later is the worst plan available. A small, boring, consistent strategy beats, I'll figure it out when it's obvious, every single time. None of this is financial advice. It's psychological advice. Let's land this with a practical framework you can actually use. First, decide what role metals play for you. Are you a protector? Then your primary goal is wealth insurance. You care less about tick bytes, tick charts, and more about how much real metal do I own, unleveraged, that helps me sleep at night? Are you a trader? Then your primary goal is profit. You care about risk management, entries and exits, position sizing. You should not marry your thesis. You should marry your rules. Are you a hybrid? Then split your metals mentally into 2 stacks: core and tactical. Core, you don't touch it unless your life changes in a major way. Tactical, you manage it more actively, trimming strength, buying fear. That one mental separation prevents a lot of panic selling at the worst possible moment. Second, build a process that doesn't depend on perfection. For example, you might decide to buy a fixed amount every week or every month, regardless of price. Then, on top of that, you add a little extra on ugly red days when everyone is complaining. That's it. Boring, repeatable, effective. Third, understand what you're really up against emotionally. When price rips higher, you'll feel fear of missing out. Temptation to oversize. Pressure to go all in. When price dumps, you'll feel shame, doubt, the urge to sell everything and swear off metals forever. When price chops sideways, you'll feel boredom, impatience. The desire to chase whatever is flashing green that week. The market's job is to push those buttons. Your job is to not let those buttons run your plan. Fourth, keep an eye on the big capital pools. The most explosive moves often don't come from more retail buyers stacking coins. They come from rotation. Think about the trillions sitting in bonds, savings products, and safe instruments that quietly lose purchasing power after inflation. If those flows even partially decide, I want less paper promise, more hard collateral, gold usually catches the first wave. Then, as the story spreads and greed wakes up, silver tends to light up. Then, if the cycle is strong enough, miners and related equities can move in ways that don't feel real. By the time the public fully notices, much of the move has already happened. If you're watching this now, you're earlier than the crowd that will show up at the end. So here's your simple action checklist for after this video. Subscribe so you don't miss the next update. Check the description for links to deeper research and the private community we're building for people who want data, not drama. Drop real OG in the comments so I know you're part of the serious group, not just a drive-by viewer. And answer 2 questions in the comments over the next 12 months. Where do you see the bigger opportunity, gold, silver, or the miners? And what one lesson would you pass to a brand new stacker starting today? Because this channel isn't just about my voice. It's about building a record of real experiences, real mistakes, and real wins. Gold and silver are doing what they're doing for a reason: persistent deficits, growing debt, policy that prioritizes short-term calm over long-term currency strength, geopolitical tension, supply constraints. You don't have to predict every tick. You just have to recognize the direction of trust. Metals are the universal language of, I don't fully trust this system. If that language keeps getting louder, you want to be positioned before the crowd and before the friction. Take care of yourself. Take care of your people. And I'll see you in the next one.